Hey, good morning. This is Mayor Valensky with Driving Markets. Driving while talking about markets. Hope you're all well. Anything said in this piece is an opinion only. Let's kick off. So yesterday, quick wrap up on where the equity markets were at. The Dow was up 72 points at 32,889. The S&P was up 12 points at 3,982. And the Nasdaq was up 72 points at 11,466. Bitcoin was down nearly $200, down to 23,318, I think it is, something like that. And the US 10-year Treasury yield for Dove was around 3.92% yield. Okay, European markets were slightly down, a bit volatility. US markets were up much higher during the day. The Dow went up to 33,195 intraday, then came off. All right, so today I want to talk about Philip Jefferson. So Philip Jefferson is one of the Fed governors, okay, and he gave his speech at Harvard all about the economy and interest rates, etc., etc. Now the Fed has a interest rate level that they want to achieve, which is 2%. Okay, and he was questioned, why don't they raise the bar? Why don't they raise that level to 4%? That way the Fed has a chance of achieving it, and they won't have to raise interest rates once they get to that level. However, he declined and resisted and opposed and challenged and said, quite simple, the Fed is insistent that the inflation level will drop to 2%. That's the official rate, yeah? At the moment, unofficial rate, as far as the Joe public is concerned and the consumer is concerned, is probably running anywhere between 15 and 20%, what you're feeling in your pocket. But let's talk about the official rate in the US, all right? Now, remember last week, indicators came out, which were lagging indicators for Phil, okay, not lead indicators, lagging, showing where's inflation's been at. Okay, on Friday out came out the PCE, which I spoke about yesterday and I spoke about on Friday, the personal consumption expenditure, which is the main measure, okay, that the Fed uses, or the most favored measure that the Fed uses when it comes to inflation, because it shows what exactly you're spending or what the consumer is spending on a monthly basis. Right now, Philip Jefferson is one of the governors also voted for an rate increase at the last meeting. He's not aggressive like James Bullard of the St. Louis Federal Reserve, but he did vote for the 25 basis points rise. Okay, there will be further interest rate rises in March. Okay, I'm saying there's going to be a 50 basis point rise in March of the Fed rates. So let's just go back to the bar of where the Fed is talking about. We're not going to go down to 2% inflation. It's not going to happen. Okay, we're now in an era of high inflation and high interest rates, and that's going to last at least 18 months. It's not going to go back down to zero interest rates, and it's not going to go back down to 2% inflation. Okay, so any of you or anyone who thinks that we're going to go back to where we were since 2010, where we've got zero interest rates for 10 years, not going to happen. Full stop. Okay, those times are over. We're going to have interest rates, and we're going to have periods of high interest rates, and we're going to have periods of lower interest rates, but we're not going to have zero interest rates. And those of you who can't get that, or anyone, an analyst or the Fed who doesn't understand that, needs to look very, very carefully at simple economics. Okay, not going to happen. Now, what's happening is at the moment is that the manufacturers and the producers and the retailers are taking advantage of the drop in commodity prices by adding to their profit line and not passing on those drops in commodity prices to the consumer. So the consumer is going to end up paying, or still paying, the same high level of pricing that was already a year ago and rising because of the exploitation of the manufacturers and the producers and the retailers to eventually the Joe public is being completely taken for a ride. Okay, going back to Philip Jefferson at the Fed has it wrong. It's quite simple, has it wrong. They need to raise the bar to at least 3.5%. Say, you know what, we are looking for inflation of 3.5%. If they get that level, 3.5%, then there is a chance by 2024 that inflation will drop to 3.5%, but it's not going to drop to 2%. Absolutely clear. And as long as they have that 2% stuck in their mind, which is from the previous era, then there's going to be rising interest rates or high interest rates going all the way through to 2023 and 2024. That is fact. Okay? Fact. What impact is that going to have now on markets? Quite simple. As rates rise, then corporate earnings get more under pressure because they have to pay higher borrowing costs. Therefore, they're going to look to cut costs. And as they look to cut costs, the first cost they're going to cut is manpower, which can be seen in the high-tech sector. So manpower is going to be cut. Manpower is going to be laid off, and that will cause a further impact on a downward turn in the economy, leading into a recession. However, there's certain parts of the economy are short of manpower, which at the moment is the service sector. So anything to do with holidays, travel, anything to do with truck driving, anything like that, the service sector, they're short of manpower, so they're sucking in manpower. Okay, so they've got a need for manpower, and the high-tech sector has an excess manpower because they've overemployed during the pandemic, so they've got to lay off. So all those companies like Tesla's, Meta, Apple, Google, CRM, Amazon are going to Intel are going to continue laying off staff. So the high-tech sector is going to suffer from a layoff, and the other service sector, for the meantime, is going to suck in any available manpower that can service the service sector. Okay, now that high interest rates and high inflation impacting corporate earnings will mean quite simply that those companies, by laying off staff and cutting costs, and then consumers hopefully holding back on their spending, which they haven't done so far up until now, will end up causing a recession. Okay, so what the Fed needs to do is quite simple. It needs to raise the bar of inflation to 4% plus. Okay, not 5%, 4%. Then hopefully inflation by the end of the year will come down to say 5%, 5.5%, and they won't need to raise interest rates, giving the economy a chance to breathe and to grow. That's simply it. So quite simple. Now, if we go into recession and we're going to continue in a high interest rate environment, then you're going to have, as I said all along, and I continue saying, the high risk assets are going to fall. Okay, all those Nasdaq shares are going to fall, and of course cryptocurrencies are going to fall. Excuse me 1 second. So the cryptocurrencies and the bitcoins, for example, are going to fall to around about $10,000 or less. Okay, Tesla is going to fall. Even though I'm a big fan of Elon Musk, Tesla's going to fall. Tesla is well overpriced at the moment. I keep saying that, but we'll talk about that in a different session. At the moment, we're talking about interest rates and inflation. This is Mayor Valensky with Driving Markets. All right, you can subscribe, you can share, you can comment. More than happy to hear what you have to say, in which direction you want this to go in. Have a good day.